Okay, so yeah, there's a list. Here are core strategy to buy stocks that meet tier one quality standards, right?
Yeah,
One
yeah,
that starts with long operating history. Yeah.
yeah. So actually, I'm going to give you sharing ability. You can share that here. So
Okay.
the first one is, so long operating history of at least 20 years. So we're looking for companies that have been around for a long time, and where maybe they used to be great companies in terms of stock performers or growing revenue and earnings.
Okay.
Eventually along the way, something happened where I guess that growth maybe stopped or got halted.
Okay.
And then, so what that does prove to us, though, that at least these companies can stick around for a long time through different type of environments. Even if they aren't growing, at least they can stick through stuff and survive, right? And a lot of these older companies, have already a good customer list, right?
Okay.
They have maybe good products that servicing a very seasoned customer list, reputation in the industry that they're serving. But a lot of times, the old management team might have either just used to that status quo and not tried to really target new markets with their products, try and create new markets for the new products for their current customers, and just maybe just stuck in the mud a little bit. And so sometimes when you got a company that's when you can find some of these companies, sometimes the manager just wakes up and figures something out, right? Or sometimes a new team will come in. Sometimes, a lot of times within the management team, like younger people within the company might come in and say, hey, they might take over the company at some because the board wants a younger team in there.
Okay.
Or sometimes they bring someone new from outside to come in there and revamp things and get things going. And that's one of my favorite types of companies. And furthermore, these older school companies, there's something about them, some kind of charm with them. They have, my experience, just still the old values about maximizing shareholder value is still there. They're looking at companies through a long-term lens, really caring about the shareholders, not only concerned about short-term results. A lot of these newer management teams, newer IPOs, newer companies, there's so much pressure to perform short-term, and they're basically brought into that culture where that's not sometimes the best way to run a company long-term. And it puts pressure on the company to maybe take shortcuts or do things in the short run that might not be good for the long run. They raise a lot of money that they should be raising money and diluting shareholders. So, my software programs in the background. So, yeah, that's the first bullet point. So that's why it's so important.
And these are for long companies, right? Long operating companies.
Yeah.
But are they also good for long operating companies? Mostly considered for long-term investments, or are they a good option for short-term investments as well? Because as you mentioned, they're used to maintaining a status quo, which means can you still expect to see radical growths with these old companies, or is it really just a slow, sustained growth?
Yeah, I think that's that you can get both. So basically, you can take a company. Maybe the stock has been doing this for a long time. Earnings and sales have been doing this. It's very constant. And then if you can find the right one where change is coming, you can get nice short-term results too. Because the cool thing about it is everything's built. The infrastructure is built with these companies. The customer pipeline is built. So if you can go in there and find a way to get 20% more revenue from your current customers by offering a new product or cross-selling, whatever it might be, that can happen pretty dramatically. So the goal is that we try to find companies that are on both that are going to reach a very maybe sometimes a short-term inflection point. Sometimes we're looking for ones that will grow long-term. It just depends on the situation, right? So, so I think that's the key is they've been around for a long time. They've not basically poisoned by the new short-term only mantra of running a company. Generally, the way I look at it is when you look when a company examines itself from a long-term perspective, it actually eventually sets it up for better short-term returns. As opposed to a one and done kind of thing. And also, thinking short-term can create companies to take too much risk. Just to get short-term results, maybe fraud. a lot of pressure, to cook the books and do things that are manipulative on the balance sheet.
Okay.
So that's it. So that's basically what we're looking for there. The second one, strong management, is, I think, self-explanatory, right? I mean, you're looking for, so some of the traits there, we're looking for, obviously, a team that has proven they can do things, right in the past. We like a lot of times when we're looking at some of these, they kind of go hand in hand. When you look at some of these longer term companies, if the same team had success in prior endeavors together, like sometimes you'll see 2 or 3 of those people come together and do really, really well. And a case study for that could be like NVEE. It's one of our best performing stocks at Geo. It's an infrastructure management company. And that was one of the key drivers of that. You had a team that came together, that understood how to grow companies in the past in the same industry. If you look at right today, on one of our stocks that we like right now, which isn't doing too good, it's a Crescendo CXDO. It's a cloud communication company. That same team built a similar company in the past, was very successful with it. But you got to remember too that when we're looking at that, if you're building the same type of company again, that times might have changed, right? So even though CXDO has the same team right now, the market environment and their competitive environment is a lot different than it was when they were running it together in the past. So that's that can bring some risk, and that's what you got to ask yourself too: is a strong management team is one thing, but are they, if they worked together in the past, what's different today that that they need to adapt to? So, for example, in CXDO, they need to adapt to Microsoft Teams getting involved in the cloud communication market. So that's a new competitor. It's emerged. It's a pretty big competitor. And so how will they be able to deal with that moving forward, right? So
the company provides a software similar to Teams. Is that what you're saying?
Well, it's basically yes and no, but I mean it's basically they offer a software platform to help companies, develop their unified communication solution. So, taking systems from on-premise to off-premise in the cloud. Teams is a solution that they can integrate into, but they also have their own UCaaS solution also. But the issue now for a Crescendo, for example, is that the management team has to understand that most people are going to want, a lot of companies are going to want to use Teams now. And now Teams are getting involved. You have it on your computer right away. It's free. Boom.
That's true. Yeah.
So Crescendo is going to, as well as like Ring Central, these companies are going to say, well, they can still, if you use them, they can still integrate into Teams. Yeah. Which is a little different than actually using the Teams application, right?
Yeah, that's good. And it integrates Microsoft Office apps as well. So it's just a lot of companies prefer that because like it can tie up with your, Excel and Word and all that. It's easy. Like there's a lot of internal integration.
Exactly. And a company that we're following also we like here is Altigen ATGN. They actually, their cloud communication system or solution was built for Microsoft Teams.
Okay.
It was built for the day that was coming. And that's their advantage. That's going to be interesting to see how they both perform. But
and they have an existing contract with Microsoft.
Well, they built their platform to their API, whatever you want, it can be used with Microsoft. So Microsoft has a marketplace where now ATGN is one of the solutions you can pick. One of the team solutions you can pick, basically. And again, this ATGN has had success in the past too. That CEO of building companies in the past, and he's doing it, and he's in a similar kind of area, and he's doing it again, hopefully here. So those are examples. Now with strong management, it doesn't just mean that what they did in the past. You also want to analyze the management team, their values. So basically, do they value having a great corporate culture? What is that corporate culture about? One of the biggest problems I've seen with management teams where they fail, especially newer teams, is in the marketing side, not having a good marketing strategy in place. That's something I'd like to ask about in terms of how they have success doing it. I like to know where they went wrong in the past in general, and see how they basically solved the problems they've had to run into, admit they've made mistakes and how they fixed them. I like it when a team's gone through adversity, maybe even failed a little bit, but come back stronger and succeeded. That shows they can do that, because every team you're going to invest in is going to eventually run into that problem, and you want to know how they get through
For
it.
sure. For sure.
So corporate culture, one of the things I like a lot too is to understand if, is a management team more focused, where they're more focused on growing revenue or growing earnings. And I've always been one to say, I'd rather you grow your revenues 10, 20% and your earnings 50%, and vice versa, or lose money. So some teams will just be stubborn enough, and you'll talk to them all till you're blue in the face, telling them to grow the earnings. And eventually that's what matters in a stock. And they say, well, no, we got to just grow revenue, raise money, debt, raise money equity wise. And all of a sudden you're in a market like you are today, where market's pulling back, and it's going to be harder to raise money at good terms.
Yeah.
And so, so that's what we're looking. That's just basic old school fundamental value kind of principles. We're looking for companies. Our basic formula is, or well, mine used to be it was a Peter Lynch formula.
Okay.
I'm looking for companies that can grow, 10, 20% revenue growth consistently for a long time, at least. And then they can grow earnings at least, 30, 40, 20, 30, 40, 50%, more than sales, really. So I like to ask a management team about operating leverage. What are they doing to be able to set up a business where their earnings can grow faster than revenue? That's what we call operating leverage in the business.
Okay.
So that's that one. So management focus on business, not stock price. That's clearly, again, what it says, and we're looking for management teams that care about the business. And the stock market's going to go up, going to go down. And for a CEO that's looking at a stock every day, isn't paying enough attention to the business, and it can be a distraction. So that'll take care of itself. The stock price on a daily basis doesn't necessarily reflect what the worth of your business is. In the short term, it's a betting. It's all betting. In the long term, we'll tell you what your stock is for. Eventually, long-term value can't be ignored at some point. So, when we're looking at that, we're trying to look. When we're looking at a company, for example, where a management team did the team or company engage in a lot of promotional activity. For example, hiring third-party professionals to write campaigns and marketing campaigns that you might see in your emails. You might see them in your emails sometimes. You might these stock picking kind of campaigns. We call those pump and dumps, right? When they're too promotional, would you rather see a company spend $100,000 on those campaigns, or $100,000 on hiring a sales rep, in the company to grow the business?
True.
So, and it ends up for being more of a situation where the company could be dinged for fraud, who knows, or an SEC violation. You see it all the time. So again, and some of these older school companies don't do it as much, in my opinion, in my kind of experience. These tier one, they don't care as much.
Sure. Can I ask a question just out of my own curiosity?
Mm-hmm.
How do you ensure that the companies that you guys invest in have all of these factors in their business and the way they operate their business?
That's really,
is there a particular research method you have, or do you have a consultant that investigates these companies, or what how do you know, how do you verify that the companies have all of these 10 features?
There's enough information out there where you can fact check a lot of it. So we go to sec.gov, which is one of our where we do where every company that's listed on a major exchange has to file their information, reports, press releases, a bunch of other data on the sec.gov website. So you can get a history of all the company for many, many years. That's like your journal of history there. You can take a look at. You can do a lot of Google these days. Just Google stuff in there, and you'll find it. Yeah. And that's how I found a lot of my. We were spending a lot of our time at Geo for a while uncovering fraud, and we would use Google a lot. I don't want to get too much in the short side of things. It's more complicated than how we do on the ground due diligence also. But for the long side, it's looking at SEC filings, looking at reading press releases, reading conference call transcripts. Those are all public information, free on the internet. And calling them, eventually calling management, interviewing them. You've been on a few of these that we've done here at Geo now, and you'll get a lot of that granularity after doing these fireside chats or interviewing management and asking these questions directly, like how do you feel about operating leverage? Tell me about some of the mistakes you've made over time. Our attack at a company is more qualitative in nature than it is quantitative in the very beginning.
Yeah, I know, especially the fireside chats, very comprehensive. You try to get complete information about the companies you're speaking to.
Yeah, it's important because it's an edge game, because anybody can look at the numbers. Every investor can go and you get the software package or get the screening criteria, and they can spit out, here's the best stocks that have the best numbers based on some criteria. Okay. But you can't. It's harder to screen for the qualitative. What are the mistakes you made? And that's where you gain a lot of the edge over other investors in mind, especially in the smaller cap area, because analysts institutions aren't really looking at this area as much as we are. So if there is a qualitative edge to gain, we're finding it before they do, hopefully.
Okay.
And other investors. I mean, the nano-cap environment really is made up of a lot of smaller investors, and some of us might not have all the time like we'd have to go through these filings and find this information. So you have an edge there. You just have a competitive edge in finding the information that's already out there.
Definitely. So would you say the average Geo follower, the investor, they invest on a more qualitative basis? Like they don't choose that many companies to invest in. They choose, a certain roster, and then they try to get as much information about them, or are they more quantitative?
That'd be a great poll for us to construct and find out about our. I wouldn't know. I mean, I think it's a little of both, but I think really more. It's just a lot of it's a story. The qualitative, and then the numbers need to back it up eventually, for sure.
Okay.
But I think what we have at Geo are more interested in really the business model, how it works, and then how that drives the numbers eventually to create value, hopefully.
I understand.
So if we go to the next,
it's very interesting. Zoe was telling me this story about this company you guys invested in a couple of years ago, who had this capacity to produce millions of dollars worth of needles for vaccines, and then you guys found out that they had that capacity, and luckily enough they got a contract with the government, and then the stock rose up like 13 or 14 times its original value.
Yeah, that was RVP, retractable technology. The stock
RVP,
$1.25, I think over 20. It's back to 4 now, 4-ish now, but we sold most of it at the higher end of that range, which was nice. But yeah, that was, and then the situation there was that was information just sitting on really government. It was sitting on a government website, just sitting there, and no one believed it.
Yeah.
So, and we bought a lot of it. Probably not enough of it, but our members are real happy on that. Unfortunately for them and that was a risk that was. And there was actually some counter pieces that were written about the company eventually, some bearish pieces that said if they don't get the contract, another one, or once COVID is behind us, they're gonna have a hard time growing. That's what you're seeing right now, and they spent a lot of money to upgrade their facilities. And
the demand went a little bit lower once the vaccines were rolled out, right? I understand.
But the cool thing is like a lot of the expansion that they did for production was a lot of it was financed by the government. So my thing is they're probably worth more now for just the asset value of the company. Maybe they sell the company. I don't know. I think that's a potential option here. And I'm glad you brought that up, because I'm gonna be looking at it again. So that was that was a qualitative in terms of the contract, but that was all numbers driven in the end, though, because that contract meant a lot to the company, revenue wise and stuff. So if we go, the next two are kind of hand in hand, generating revenue and at or near profitability. So we're looking companies. We're not trying to look for development stage companies here at Geo. We're looking for companies that have revenue. I mean, it can be anywhere from 2 or 3 million revenue to hundreds of millions of dollars revenue, right? But we're not looking for generally ones that have zero revenue.
Okay.
And we're looking for those that without revenue is already starting to generate profitability, or right there basically, because we want to be able to value a company on their earnings, not necessarily, the revenue. We can value on revenue also, but we prefer to have this company has a value on its earnings, and that's either today or 3 years from now, whatever it might be for the model. But if they're not trading at near profitability, we run the risk of or revenue, really. I mean, if they're either one, if they're lacking revenue or lacking profitability, you run the risk of the company having to raise money to generate revenue, or raise money to generate profitability. And when you do that, you're diluting your ownership interest in the company. When you issue shares, you're basically giving ownership to other people, and you're getting your ownership diluted. And that's like the worst thing in the market is dilution. We don't want that. And the stock will always sometimes, when you have here, we call it the good stock, the good company bad stock syndrome, or you might have a company that's doing growing its revenue and all this great money, and might be losing a little money, but they're trying to get there one day, and they're issuing shares, and they end up having a great company one day, but really bad stock because they diluted the stock so much over time. So generally speaking, I'll get to that in a second, actually, what that means more in a second. But that's pretty easy. So our formula again for that is we're looking for companies that can grow revenue at least 10 to 20%, and grow profitability in multiples of that, higher than their revenue growth. So maybe at least over 30%. And that was really, I think, a Peter Lynch principle. That's why he was the first investor that I investing legend that I kind of was attracted to. And that's, I used it for years. Now, I'm not going to, there are some exceptions to the rule sometimes. So if I'm investing in a company with recurring revenue, like INXSF, InTouch is one of our InTouch Insight, which is it's a customer experience management company. They help companies understand their customers and make sure they're serving them right, understand that the protocols they're following at different branches are being followed by employees. And they do polls, mystery shopping, the kind of things. So they have a lot of recurring revenue. So if I'm looking at that kind of company, I'm okay with them running like a break even or slightly around profitable or around a loss, because you have that predictably the revenue. They can keep pumping that revenue back into the company to grow, and they don't have to raise money if they're at that break even level. But you want them to pump that, get that recurring machine going. And at any time, those recurring revenue companies can often just turn off the marketing, just take a little off marketing, and they'll become profitable. So if I'm looking at a recurring revenue company, that's one situation where I might make an exception, where I'm okay with them operating at break even if they're growing revenue very rapidly and being able to finance their growth through the revenue they're making and their cash flow.
Okay.
But there's an exception. There's probably industries, other industries that I don't play in some of them, but that might have reasons for investing in their, if there's maybe they're cash flow positive, maybe they make earnings, they're generating a lot of cash flow. But generally speaking, that's where I'm at. We love high probability turnaround stories because those are stories that maybe we're going through some problems in the past and they're being ignored by a lot of investors. So they're like the black sheep sometimes. And you can get those early if you get this at the right time. You can get them early, or you can get them at the inflection points. Doesn't matter. You can, if you want to take a little more risk and get a stock maybe really cheap, potentially because it's been beaten down so much in a turnaround story, or you can wait a little bit to see how turnaround's going before you get in. But we like them because it's just a situation where you might have a lot of investors ignoring them. There's a little higher risk to them potentially. So if you're more risk averse, you need to start looking at these after maybe the 7th or 8th inning, maybe, of a story, kind of getting momentum, and they're just about to go profitable, maybe something like that might be interesting. So depending on your appetite for risk would determine when you might want to get involved in the turnaround story. Now I'm saying that a tier one company is not always a high probability story. I got to change that. It should say when relevant. So we're not looking for turnarounds, but there are high probability turnarounds that can be considered tier one. And
Is this a prerequisite for
a tier one? No,
for a tier one company
it's not.
that
That's
they
why
had some challenges that there was a turnaround?
it's not. That's why I should actually modify that bullet point a little bit. It should say high probability turnaround stories when relevant. So if we are looking at a turnaround story, we need to make sure it's a high probability before making it a tier one.
Okay.
But you know, for example, a high probability turnaround would be one maybe where you have a lot of the other elements there, like the first two, long operating history and strong management. Those are very important for high turnarounds, high probability turnarounds. So
Okay.
yeah, but we do like the right turnarounds though, and a lot of times, like if you get it right, if you buy in the right time, you can get a pretty big move pretty quickly, you know, and sharply if you do it right. One of ours was Blue Links BXC. The stock is on trading right now around $80. We found it around $8, probably
Wow.
a couple of years early before its turnaround. But when the whole turnaround occurred, it went from like $10 to $40 in one day. You know,
What was the catalyst that made them?
so they were one of the largest lumber what do you call it, distributors, like for home builders in the home building industry basically. And they were they almost went bankrupt because of the 2008 recession, and the activists came in, a new management team came in to basically put the company on the right track to grow and restructure the whole operations. A big issue with them was they had a lot of debt in the balance sheet, and they also had a lot of assets though, real estate assets. So what they ended up doing over the several years was selling off the real estate assets to basically pay down the debt.
Okay.
And eventually that got to a point where it was, you know, the company could make money, but more importantly, they got to a point where they were able to delever the balance sheet to where they could actually make an acquisition of a company. And when they made that acquisition is when the stock went up like crazy, and then the next day.
Okay.
So they basically got themselves into a situation where they were they still had some leverage, but they got to a better point where they could actually get to a point of delevering enough to make an acquisition.
Okay.
And part of that was there was an activist who was involved in the company. They owned, I think 51% of the company, I think, or something like that, or close to it.
Okay. So like controlling share?
They were, and they were more probably interested in the company selling the company. So that company eventually, I believe, sold their stake in an offering. So once they sold their stake, right, that freed the team up to go, you know, do what they wanted to do without them, you know, looking at them. And it was weeks after that happened that the acquisition was made. You know, it was kind of cool. So that's another list to add. So if we were going to make a journal, that's one maybe interesting screen, looking for these situations where you have a big activist involved, and when they get out, if they get out, maybe that either means A, they gave up because it wasn't good, or B, hey, they just ran out of time, and now the company can go do its thing without the activists and maybe create value. So activists can create value, but maybe them not being there can also unleash value too, because the management team can do what they want to do. So that's what happened there. High insider ownership is very, you know, self-explanatory. You want management teams that have skin in the game. And if you'll start noticing a lot, Sanjay, that we look for companies that are filing what these Form 4s. It's an SEC filing. It's called a Form 4, and that Form 4 will tell you if a company is buying stock, for example, if insiders are buying stock in the company. Okay. Insider will be a CEO, CFO, management team. It also will highlight, you know, maybe some big holders. So in that situation, we're looking for companies that are actually buying stock on the open market, like putting orders to buy stock. We're not talking about them getting options or grants in the company. They're taking their own money and going out there and buying it like you and I buy it. So that's a whole different topic of discussion, how we go through those filings. But we're looking for companies that have insiders, that have skin in the game, especially right now the market's pulling back, we want to see companies out there showing us, hey, we believe in the company.
Yeah.
Give us some confidence as your price is going down. Another bullish though flag is if a company is stock is hitting highs, going up and up and up, and insiders are still buying stock. That's a pretty cool signal too.
Yeah, because they know that they have nothing to worry about, right? They don't need to dump their stuff.
Well, the thing is too, there's a saying by Peter Lynch. Insiders will sell their stocks for a number of reasons, right? You got to buy a car, buy a house. Who knows what it is? You got a divorce, but you'll buy a stock for only one. You think it's going to go up, right? So
True.
It's a lot stronger signal of buying and selling, but they can both be used. Another cool bullish flag is if you look at a company that hasn't bought.
That's true.
The CEO hasn't bought stock for years, and all of a sudden he starts buying stock. That was like in the BXC situation.
Is there a way? Sorry, didn't mean to interrupt you.
In the BXC situation, which I just talked about, with the one went from like $10 to $50, now it's $80 now. When that activist got rid of their position, all these insiders started buying stock. So it was just all this wonderful stuff happening at the same time.
Is there a way to identify when the people from within the company, from when insiders are buying their own stocks? Is there a way to find out, like, oh, for this company, the people are buying their own stock? Like, is there a way? Like, is there a resource online that gives you that information?
Yeah. So basically, on the SEC.gov earlier, which is that.
Okay.
When that kind of transaction occurs, a company insider has to file a Form 4. It's called a Form 4, and that Form 4 will tell you how many shares that insider bought or sold.
Okay.
And it also tells you how he acquired those shares. Did he acquire by actually taking money and buying it, right?
Okay.
Or did he receive an option or a grant? And there's different codes. I think it's 26 codes. I can't remember. Or it's here 13 or 26. I don't know why I'm thinking about it. I wrote an article about it. We call them the secret codes, and it's you can go find it eventually on here. Maybe Zooey can give it to you too. Take a look at it. But it goes to the example of what you would do there. I wrote 2 articles about that, we're using that heavily right now as the markets get in the situation where it's in now. We're trying to find these stocks that got crushed and punished unfairly, and we're trying to see insider flow in some of these companies and see if we can trust any of them. You always want to combine that though with fundamental analysis too. You don't want to take it for granted just because you're buying stock, it's going to go up. You want to combine that with. There's been some studies that said if you just buy that the insider buying kind of analysis can give you like a 12%, I think, or 9 to 12% alpha over the market. So, or a return. I don't know if it was the alpha or actually the return, but let me actually go find it right now. We're talking about it. Give me 1 second here. I actually want to find that. If we go to GeoInvesting.com, and then we type in, I think it was called Form 4 101, or let me see, Form. Is that a video there? That's a video. Here it is. It's called Form 4 Filings, Insider Buying 101. That's the article. Okay, 11. Yeah, so 11%. The insider anomaly advantage has been estimated to be as much as 11 percentage points over the market return annually. That's by a website called Insider Monkey. Some people will disagree with that and say that advantage isn't there. My whole thing is like, if that is true, that I didn't do the study, and it'd be a pretty cool study to try and replicate. Imagine if you can take that insider buying kind of analysis and then combine it with actually fundamental research. That 11% advantage is from doing nothing, just by buying the stocks that had insider buying, right?
Yeah.
And my kind of thing, if you take that and you do it with, and I bet you it's more relevant for smaller companies than larger companies. It's a lot more relevant a CEO of a smaller company is buying stock than the CEO of Intel buying stock, probably, right? It's a whole
Is it
different.
because there's a higher growth rate for small
Well, no, I
companies?
mean, like the CEO of, I mean, typically a CEO of a smaller company is probably like he's all in. He's not making it, he's not making crazy amount of money in his real life. So any money he spends in the stock could be very relevant to his wealth, right? Or a significant for like you take a company like a beer cap CEO who's making maybe a lot more, like millions and millions of dollars. Who cares if he buys 10,000 worth of stock? you know. So it's a smaller companies like CEO. It's probably a bigger investment for them as a percentage of his total wealth. So it probably means more.
Okay.
But that's not always the case though. But it could be a situation to consider. All right, so now if we go back now, we keep on going down this list. Then we go to, debt burden. We would look at a company that doesn't have a lot of debt. Preferably, we're looking for companies that have, we don't mind some debt positions, but we're looking at maybe 20% of overall equity. Maybe.
So the debt is 20% of the equity.
Well, yes.
Okay.
Yeah.
So okay. All right.
So
Understand.
that's kind of a thing we look what we look at. But look, if we don't mind it, if it's over it, there might be a reason to consider it. But you'll find out that when we're looking at high probability turnaround stories, a lot of them will have a lot of debt. We want to know if there's a high probability that debt will come down over time. So they kind of go hand in hand a little bit. So in some issues there, other things we could be looking at, like if they have high debt, well, maybe they're going to restructure debt. So to get better payment terms. You restructure by lowering the rate. You can structure it by extending the term of the loan, right? To spread out the payments a little more.
Okay.
Look at it. So yeah, but generally speaking, we like to, and as rates are going up now too, we'd rather have this is a more important part of our analysis now, because if you need debt and have a lot of debt in your balance sheet, you got to refinance. You're going to be doing it at higher rates, which is going to reduce your earnings potentially, unless you get a high return on your debt. But anyways, but that's pretty self-explanatory. And then the next two are probably like they work together. Ability to grow without excessive equity raises, and shares outstanding are not excessive. Really, this is a capital structure thing. We're looking for companies that are able to grow, have a history of growing organically, not having to raise money all the time to grow. That their own cash flow they generate from their operations can help fund the growth of the company. So what we'll do is we'll look at the company's shares outstanding over time. How has it grown over time? To give us an idea if they've been watching that closely. So we talked about dilution earlier. So increasing your share count, outstanding shares, will increase your dilution, and we don't like that. So that's why you'll see a lot of times I'll say, well, part of my criteria when I'm looking at companies is I don't look at companies that have these nano-cap companies that have 50 million or 100 million outstanding shares, because it shows me potentially that the company has been very hasn't really cared about that part of the equation. Just very lax issuing shares to grow, and maybe the money they're raising from doing that hasn't been working, providing good returns on capital. A lot of times I'll raise money to buy acquisitions, and if you see a lot of this going on without a lot of earnings coming out from it, it shows that the company hasn't been a good kind of user of that capital. So generally speaking, we're looking for companies that are probably under 50 million outstanding shares. Now remember, I'm just using some basic criteria for a smaller company. Of course, valuation matters. So if the valuation relative to shares is good, I understand that too. But what I found in this nano cap world is that the bigger share count, at least in the U.S. stocks, it usually is a bigger prescription for failure. Now, there's some exceptions to that. So if you come into a stock that has a lot of outstanding shares, sometimes that was because of old management. If new management has come in, that wasn't maybe their fault.
Okay.
So maybe they come back and maybe they'll start buying back stock to reduce it. And maybe they'll do a reverse split. And I don't want to talk about that now, but reverse splits reduces the amount of outstanding shares to look clean, right? At least to look better cosmetically. And then we want to analyze them from that point on, how they're going to do. So there's always some exceptions to the rule, but generally speaking, man, I just like that formula of low outstanding shares. It shows me that management team has been committed to growing the company organically, not issuing shares like candy, only issuing them when it made sense to maybe make a great acquisition, maybe a small raise here and there. But
Okay.
yeah, that's and yeah. And by the way, when companies do raise money, I like it when you have broad management participation in the money raise. So if a company's going to raise 20 million, it'd be great. It's great when you see a management team maybe put 5 million in that $20 million raise, right? Or maybe the board of directors, CEO, CFO. So we like to see that kind of too. It's a bullish thing. Okay. So that's kind of the some of the stuff here that kind of makes up this tier 1 list and some of the stuff behind it. We're going in this different market environment we're in now. That list there, I think, is more important than ever now. Time these really high quality companies at a time where we're going.
Well, I'm sure, especially now that the last 8 or 9 months have been generally bad for the market, bad for stocks. Generally, markets have been down for, I would say, like 9 months or so, right?
Yeah, this is really since November, December. It's been is when this all started, really. I just think the search for I think quality is going to basically rise to the top now in terms of what people are looking for. Look, I mean, pump and dumps and speculation will always be part of the market, but that dominated a lot of the last 15 years. Sexy stories, growing revenue. I think that'll still be relevant, right? But for some investors, but I think that the leading theme will be the quality now, and valuing companies on their earnings, not just on their sales. That's a really important part of what we've been talking about here at Geo. Cool, man. So if you have any questions in this, we can talk again about it. No rush, but it's there for you if you want to, play around with it here and there.
I appreciate it.
All right, Sanjay, thanks, man. It's been great. Great we've been here with Sanjay.
Thanks for explaining.
New team member on Geo.
Everything, and you made it so easy to understand. Yeah.
All right, thanks, man.
Sounds good.
Good weekend. See you.
Yeah, thank you so much. You too.